Everyone in crypto talks about risk management.
Risk management?
Set your stop loss.
On this channel, I often discuss the importance of stop losses.
Always ensure that you reduce the impact of your investments dropping in value by using stop losses.
Only risk 1% per trade.
Don't base it off money. Base it off of percentage.
Watch the volatility. But here's the truth. That is only half the story. And the half that they're missing is costing you money every single day. Imagine sticking your hand in a lion's mouth. Your girlfriend says, "Don't worry, my dear, just wear this rubber glove. You'll be fine." That right there is the guru playbook on risk. Set a stop loss, risk 1%. Yeah, great. But what if the whole hand-in-mouth concept, the trade idea itself, is a guaranteed fail 98% of the time? That flimsy rubber glove, well, it's not looking very helpful now, is it? Stops are tools, but it's position size. That's what matters. And focusing only on containing the loss after you've made a dumbass bet, well, that is treating the symptom, the loss. The disease is taking that pointless negative expected value trade in the first place, isn't it? You see, a tight stop on a losing proposition, that just means that you bleed out slower. It's death by 1,000 cuts instead of one clean, decisive cut. Either way, you're still castrating yourself financially, aren't you? You see, real risk management, well, that starts before you get into the trade. Mathematically, risk isn't just how much you can lose. Risk is the probability that you lose multiplied by how much you lose. Poker professionals live by this. They use pot odds. Let me show you. The pot is $100. The villain bets $25. Now there's $125 in the middle. It costs you $25 to call. So you risk $25 to potentially win $125. The pot is giving you $125 to $25, which simplifies to a 5-to-1 pot odds. Say you have a flush draw. You need one more heart, and you estimate that your chance of hitting a heart on the next card is about 19%. That means that the odds against you hitting are roughly 4-to-1, which means that you'll miss about 4 times for every 1 time that you do actually hit. All right, okay, that was quite a lot of information, so let's zoom out for a second. The pot offers you 5-to-1. Your odds of winning are 4-to-1 against. Because 5-to-1 is better than 4-to-1, this call has positive expected value, positive EV. Even though you'll miss the flush most of the time, about 81% in fact, the math tells us that making this call consistently over time, over long enough trials, will make you money. And that is what I mean by thinking like a professional. It means calculating the odds. Back to crypto, because we need to understand how all this poker stuff actually applies to our world, to crypto. When your favorite influencer says, buy here at support, stop loss below the low, target the previous high, look, 3-to-1 reward to risk, great trade, what you should actually be asking is, hang on, whoa. What's the probability that this setup actually works? Because let's say, based on data and backtesting and out of sample testing, this specific pattern works, 40% of the time. Positive EV. Look, even losing 60% of the time, this trade makes you money in the long term. Good. That looks like it's a viable setup. We can at least consider it. However, look at this. Buying way up here after it's already run harder than this guy at the London Marathon. Your guru says, tight stop. Maybe it goes higher. Still 2-to-1 reward to risk. Chasing moves like this, the probability of further upside without a nasty pullback here is low. Let's say it only works 15% of the time from this entry point. So let's run the numbers again, shall we? Look, hey presto, negative EV. This trade is mathematical suicide. No matter how good the reward to risk looks like on paper or how tight your stop loss is, you, when you get into this trade, are just paying to lose. Do you see the difference? Reward to risk ratio alone is a big fat lie. Probability is the missing half that you, must consider. Real risk management demands understanding both reward to risk and the probabilities. You can't manage your risk properly until you've got both of those sides accounted for. So how do you actually apply this? Well, it's a simplified process. It's not guesswork. Here's a simplified version of my approach. Step 1, identify and classify the setup. Is this a high probability pattern based on historical data and out of sample testing? Is this your ace? Or is it low probability nonsense like 7-2 offsuit? Step 2, determine logical reward and risk and set a rational entry, a stop loss and target levels based on market structure, not just wishful thinking. You have to calculate the potential reward versus risk, the RR ratio. Step 3, estimate probability. And this is important. Use back-tested and out-of-sample walked-forward data, pattern recognition stats, whatever gives you a realistic win probability for this specific setup type. If you don't have that data, then calculate it. If you can't get that data, then what are you going to do? Carry on pissing in the wind? Because this is where my trading system does all the heavy lifting for me. And step 4, calculate the expected value. Plug the win percentage, the loss percentage, the reward and risk into the EV formula and check, is this positive? If it is, great. The trade is potentially viable. Is it negative? Oh, well, come on then, for Christ's sake, fold. Fold immediately. Why on earth would you trade this? Now, let's think about what you're doing when you use this framework. You are shifting your focus from hoping to win to making mathematically sound decisions that maximize the weighted probability that you do win. That is the only way to survive and make money long term. Not because I said so, but because the numbers said so. The biggest lie in crypto is not that stops don't matter. They do. They obviously do. The biggest lie is that stops alone are enough. They're not. Real risk management, proper risk management, is about maximizing positive expected value through intelligent trade selection. And bearing these key factors in mind, really pause and internalize these points, because these are the key ingredients to printing consistent gains, not just the odd 1 or 2 great trades and then you lose it all next week. We want consistent gains, and these are the points, these are the ingredients that we need to nail down because they're the key to consistency. In the next video, we're tearing apart those so-called safe crypto strategies, the ones that feel conservative but are actually designed to slowly bleed you dry with negative EV. Think DCAing into oblivion, grid bots in chop. Shit's gonna get brutal. You're gonna wanna see it. So you tell me, are you calculating risk like a pro, or are you flailing around like someone who's trying to perform a colonoscopy with a blindfold on? Oh, you don't have a blindfold on? Well, subscribe then! And I know that you learned something today. So do us all a favor and hit the like button. You know you want to go on. Listen. Trading is not about being right all the time. You can't be right all the time. I know I'm not right all the time. Nobody can be. But it's about having the odds firmly in your favor when you put your hard, cold cash on the line. Start thinking about risk the right way, the proper way. And I'll see you in the next video.